Hey everyone, and today we are going to talk about two interesting companies that are quietly making big moves in their industries. The first one is a pharmaceutical company which kicked off FY26 on a strong note with revenue up by 23% and profit doubling. And the second company is an agrochemical exporter and it's delivering big too. Revenue rose 25% with sharp jump in profits backed by strong volume growth, better pricing and wider global reach. So basically, both the companies are expanding steadily, one through therapy-led expansions and smart acquisitions in pharma, and the other one through scale, pricing power, and global product reach in agri markets. So welcome to another episode of Noisemaker, where we keep things simple and focus on companies that may not always come in the spotlight, but they have a really good, strong potential in the long run. I'm Saizal Agarwal, Equity Research Analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, and if current trends remain intact, they might continue to grow even further. But before that, let's have a quick look at the disclaimer. So any discussion, facts or writings provided here are for informational purposes only and do not constitute any buy or sell recommendation. So please conduct your own due diligence before making any investment decision. Now let's move to the first company. So Jagsonpal Pharmaceuticals Ltd is a specialty pharma company that manufactures branded formulations and APIs with a focus on high growth segments like gynecology, orthopedics, dermatology and pediatrics. In Q1 FY26, the company kicked off the year with impressive numbers. Revenue rose by 23% year-on-year, net profit doubled to 10.8 crores, EBITDA grew 24% to reaching 15.7 crores with margins steady at 21%. What stood out was the free cash flow of 15.3 crores, taking the total cash reserves to 160.9 crores, all thanks to tight cost control and efficient working capital management. The company also benefited from the acquisition of Yash Pharma, which expanded their product portfolio and helped them boosting volume-led growth. So now Nishant would be joining in for more. So Nishant, what's your view on the kind of momentum they are building in this quarter?
Yeah, thanks, Cesar. So, what really caught my eye was how consistent the execution has been despite a traditionally lumpy industry. Their core brands continue to perform well, and the margin stability indicates strong pricing power and operational discipline. Talking about the company's FY25 financially, revenue grew by 28.7% from 208.7 crore to 268.7 crore, and net profit also more than doubled to rupees 55.4 crore. Even with quarterly volatility, they closed the year on a high. Net margin for FY25 touched 20% and EBITDA margin expanded by 410 basis points to 21.5%. That's a solid sign of improving leverage. So clearly they have led the groundwork for sustainable profitability. But Cecil, what are your thoughts on their long-term guidance and capital allocation approach?
So that's where I think Jagsonpal stands out because they have laid out a clear roadmap. For FY26, they're targeting 15% plus revenue growth, and over the longer term, they expect to grow at 12 to 14% CAGR with margin expansion of 100 to 150 basis points per year. So, what I find most interesting is their plan to increase sales productivity from current 2 to 2.1 lakh per MR per month to 3 to 3.5 lakh over the next 2 to 3 years, and that too without expanding their field force. And that's a smart and cost effective way to scale. Also, they have embarked 160.9 crores specifically for acquiring scalable domestic brands, mainly in gynecology and pediatrics, and they are being extremely disciplined. If the fit is not right, they are willing to return the cash to the shareholders. That's the kind of clarity which is rare. So, Nishant, what do you make of their acquisition strategy and capital discipline?
Yeah, I think it's a very grounded and mature approach. They have already shown this by backing out the resilient deal, which wasn't aligned strategically. Also, it shows they are not chasing growth for the sake of it. They are prioritizing long-term value over short-term wins. Plus, all acquisitions will be India-focused and therapy-specific. That helps reduce integration risk and keeps execution sharp. With rupees 160 plus crore on the balance sheet, they have the firepower, but they are not desperate to deploy it, and that's a strength in itself. So to sum up, Jagsonpal looks well positioned through strong core brand growth and margin discipline. Also, rupees 160 plus crore cash reserve with a targeted M&A approach, long-term productivity growth without high cost inflation, consistent improvement in free cash flows and return ratios. If they stay this disciplined and focused, they could quietly become a formidable player in the Indian branded formulation space.
Okay, thank you, Nishant. So now let's move to the second company, which is Sharda Cropchem Ltd, a global agrochemical exporter primarily focusing on technical grade chemicals and formulations, but they also deals in non-agro products like conveyor belts, rubber sheets, dyes, and intermediates. They began FY26 on a strong note. Q1 revenue came in at 985 crores with 25% year-on-year growth, and this growth was largely volume driven. Agrochemical volumes rose 11.4% and non-agrochemical volumes surged 58.5%, especially from Europe. And that's an impressive spread. Talking about profitability side, things really picked up because the net profit of the company jumped 424% year-on-year to reaching 143 crores, all thanks to better product mix and firm pricing. So Nishant, what's your take on this sharp turnaround and where it's coming from? What do you think?
Yeah, I think it's a great example of scale meeting strategy. Sharda's business model is quite asset light but forward integrated, meaning they focus more on marketing and registrations rather than heavy manufacturing, and it's working. In FY25, revenue jumped nearly 37% from rupees 3163 crore to rupees 4320 crore. EBITDA more than doubled to rupees 682 crore, and margins rose from 10.1% to 15.8%, which shows not just volume recovery but pricing strength too. Interestingly, Q4 FY25 was a blockbuster, rupees 1829 crore in revenue, up 96.8% sequentially. Q1 FY26 did dip seasonally, but still beat expectations. So overall, they are managing volatility well while building on core strength. Saisal, now I want to ask, what's your view on their registration strategy and capital allocation going forward?
So Nishant, that's where I think the real moat lies. Because in Q1 FY26 alone, they spent 114 crores on capital expenditure, mostly toward expanding their product registration base. And as of June 2025, they had 2,981 product approvals, 1,021 filings under review, and that's a huge pipeline. For FY26, they have also planned 400 to 450 crores in capex, again focused on registrations. And this strategy not only builds regulatory entry barriers, rather, it also gives them a stronger pricing edge over time, since each approval opens up new market without the need for large physical assets for the company. And their distribution network is also expanding fast. 525 distributors, 500 sales professionals, active in more than 80 countries. So scale puts plus local execution is what's driving their reach. So Nishant, how do you see this playing out in the long-term growth for the company and about the margin outlook?
Yeah, I think it positions them for very targeted global expansion. They are not entering blindly. They have leveraging their approval base to enter markets where the risk reward is favorable. That also makes them more resilient to price fluctuations, especially in agrochemicals. The company is guiding for 10 to 15% revenue growth and 15 to 18% EBITDA margins in FY26. That seems realistic given their pipeline and pricing tailwinds. What's also worth noting is that their agro segment is picking up steam, especially in Europe, which can help smooth out seasonally in agri demand. So if we put it all together, Sharda seems to be building from strength through consistent volume growth and improved product mix, massive scale up in global product registration, expanding footprint across 80 plus countries, and a capital light, high ROCE business model. So if they stay focused and keep executing on this registration led strategy, they could quietly become a major global force in the agro exports space.
Thanks a lot, Nishant. That really helped us to understand the direction both these companies are moving in. So now let's take a quick look at how some of our previous picks have performed. So the first company is Nova Agritech Limited. We picked this up at 49.5 rupees and it's now at 57 rupees, giving a return of 15.2%. GMM Pfaudler Ltd from 1271.4 to rupees 1315.6, and that's a gain of around 3.5%. Oriana Power Limited, it moved from 2190 to rupees 2213.5, delivering a modest 1.1% return. Then Paras Defense and Space Technologies Limited, this one saw a dip from 818.9 to 717.4 rupees, which is a decline of 5.8%. And lastly, we have Gabriel India Limited. We picked this up at 842 rupees and it's now at 997.8, giving a return of 18.5%. So overall, a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape in the coming quarters. And here is the QR through which you can access all these previous picks. Now let's move to the summary of today's companies which we included in today's Noisemaker. So the first is Jagsonpal Pharmaceuticals Ltd, where the company started FY26 on a strong note with Q1 revenue up by 23% year-on-year to 756 million and net profit doubling to 108 million. Sharda Cropchem Ltd, where the company began FY26 on a strong footing, reporting Q1 revenue of 985 crores, up by 25% year-on-year, driven by 13% volume growth across both the core segments, agrochemical volumes and non-agrochemical volumes. So that's it for today's edition of Noisemaker, and if you find this breakout informative, you can scan the QR code to read the full report, and we'll be back soon with more simple and clear market updates. Until then, stay curious, stay ahead and stay informed.